Hi, and welcome to Great Quarter Guys, where freight meets finance. My name is Kevin Hill, here as always with Andrew Cox in a remote location, coming at you today. This is episode 42, and how are you doing today, Andrew?
I'm good, Kevin. Thank you. Thanks for having me. Yeah, this is the remote location of my living room here. You'll probably see my mischievous cat running across the screen at some point, so everyone be prepared for him. He'll be coming in soon. But yeah, episode 42, how big is that? Jackie Robinson episode. Who else could it be if we're going to do a number 42?
Yeah, you can't pick another 42. That it's retired in Major League Baseball. I think Jackie Robinson Day was not too long ago this
Yeah, they actually
year.
did a whole weekend. The entire weekend, Friday through Sunday, all the players wore number 42.
Yeah,
And the Braves
tradition.
swept the Red Sox during those numbers, so I was happy to see that. In Boston, by the way.
That's good. At least the Braves are doing okay this year,
yeah,
right?
The Braves are in first place. We're happy about that. So let's hop on to our ode to highly questionable, which is see or no. We're going to do you care or nah. We've got 4 of them for you today, Kevin. Number 1, we'll stick with sports here. This is Michael Jordan. Some big news. He joined DraftKings as a strategic advisor. Do you care or no?
I don't really care. Did DraftKings buy the other place that used to throw on commercials? 95. Yeah, exactly right.
I don't think so. I don't think that deal ever went through. I think there was some antitrust issues that kind of stopped them, and I don't think it ever finalized.
I think you're right about that. And, I just remember a few years ago, 95% of commercials on any sporting event were either DraftKings or the other one. I think they have such market share and such advertising pull that I don't really think it moves the needle all that much. And I'm not sure what Jordan can actually bring that especially with product quality or product or new products. So I don't really care.
I disagree with you, and I think the market disagreed as well. DraftKings stock was up like 8 or 9% on this news. I think it's a big deal. I got to disclose, I am a DraftKings holder. I'm long this company. I'm not only long DraftKings, but I'm long the industry of online gambling. I think it's going to be huge. The U.S. It's a shame that the U.S. is so far behind the rest of the world in this aspect. I mean, I am glad there's not a Paddy Power on every corner, a little betting shop on every corner like there is in Boston or London. But it's about time we have nationwide online gambling, and I think DraftKings is, as you said, the top player right now. They own a massive part of the market. They're going to be battling with Penn and others, but I think this is a big deal. You're getting the best athlete of all time, one of the best business acumens of all time for a former athlete, and you also get a very big gambler in Michael Jordan. That man loves to gamble, so I think putting his name on any type of sports gambling is a good place to be. So I do care about that one. Okay, second one for you. We got 2 back-to-back on cars real quick. The first one is new vehicle sales. This is kind of a dichotomy that's evolving here. The first one is new car sales are down about 13% year over year in July, but the average price is up 6% year over year. Kevin, you care or not about that stat?
I do care about it because it's a little confusing. It's counterintuitive. I know you have a really good explanation for that. I think people who are financially secure, who can afford cars, should be buying. So it makes sense that vehicle sales are down, specifically because you're working from home, right? There's not that demand, that natural demand for automobiles right now. Now, the price increases, I don't know if that is, as you say, because of higher end cars, or maybe some of the components or pricing power, which doesn't really make sense either. But it's confusing. I do care about it because it's a trend that we'll be talking about later a little bit with alternative vehicles. But yeah, it's confusing, but everyone should care about auto numbers.
Yeah, I don't particularly care about this stat. I find it interesting, but I don't particularly care. I mean, you have a combination of limited stock right now. The manufacturers were down for almost 3 months there in the early part of the year due to COVID-19. You have cheap financing. Rates are next to zero, and people are getting really long-term. I've seen 20, 30-year car notes these days, which is new. They haven't been doing that very long. And you just have consumers gravitating to higher price cars because of that. And it's usually bigger cars. Younger people are kind of getting priced out of this market. Nobody's buying sedans right now. I read something that somebody from Toyota saying they're producing all of the Tacomas, 4Runners, and Tundras that they possibly can right now. People are wanting bigger cars, and low gas prices also deal with that as well. But overall, I don't particularly care. Luxury's benefited from this, but it's really just a shift to bigger cars. I care more about the next one we're going to go into than this one. Don't really care too much about this. But number 3, this is about China's car sales. So China's car sales grew at the fastest rate in more than 2 years in August. I think it was up 9% year over year in August. Kevin, do you care or no?
I do. It's a developing economy, of course. It's the second largest economy. There's a burgeoning middle class there. So I think this is the long-term story, kind of like America in the 1950s almost. I do think that we're almost to peak output or peak demand annually here in the States for cars. I don't think that it's a huge growth engine at all anymore. But I think in China, and it is a huge story, and it's a trend that will last the next few decades.
Yeah, I care about this. This is the largest car market in the world, largest luxury market in the world. So the biggest market for Tesla. Of course, I'm going to care about this as a Tesla holder. Tesla currently has got like 80% of the EV market share in China, and they're growing that luxury market share, which is historically been dominated by the 3 big German automakers. So I definitely care about this. Chinese growth is good for Tesla. So I'm good on that one. Okay, the last one here is about Airbnb and Marriott. And I've actually got a graphic here that I'm going to get the production team to throw up because I found this interesting. This is some research done by Axios, where they indexed the revenues year over year, 2020 compared to 2019 for both Marriott and Airbnb. And of course, Marriott is getting smashed. They're indexed down roughly 50% right now. If you can look at that chart on the left. On the right side, you have Airbnb, who had a massive drawdown, but has quickly rebounded. It is now up roughly 75% year over year in revenues. So this is actually the first time that Axios believes is the first time that revenues for Airbnb have comfortably been above Marriott's. So that's a big deal for me. I guess I've kind of foreshadowed that I do care about this one. But Kevin, I'll throw it to you. Do you care or not about Airbnb spending weekly up year over year, 75%?
I do, yeah. I really do. I think Airbnb is the wave of the future. I think it's, especially for vacations and long-term rentals, it's much better being in a hotel. 1 or 2 nights in a hotel. But if you have a family, if you have extended family that you want to take family vacations, there's no better way to do it than an Airbnb or a VRBO. They offer the true vacation packages where you can cook your own food. Sometimes you have a pool. You're in a great location. So I think it is a trend of the future, and I think it really shows what's happening in the COVID type of landscape where business travel has virtually gone to 0%, which really hurts Marriott, and family vacations, jump in a car and drive somewhere to get out of town for a little bit, are still alive and thriving.
Yeah. Most definitely. So yeah, as I said there, I do care about that one too, kind of foreshadowed my feelings. But let's go ahead and bring in Ben Gordon. We're going to continue our conversation from the Carrier Summit with him here today. We've got this first story that's come out about SoftBank, and I do want to bring Ben in to join us here on this one. And this is kind of a funny story to me. Everyone has been blaming these poor Robinhood traders, like our own Kyle Taylor, these Robinhood options buyers, for all the recent surge in tech prices. But it turns out that it's been Masa Son and SoftBank all along buying these massive call option positions. This actually came out of the Financial Times. They first reported this on Sunday, that SoftBank is sitting on unrealized gains of roughly $4 billion from Masa's aggressive option strategy that he's played out over the last couple months. SoftBank's purchased about $4 billion worth of options, mostly calls, and these are calls on big tech companies like Tesla, Apple, Netflix. They've been across the board. But the things that's come out of this is Nomura Holdings out of Japan has said that SoftBank has created a bit of a feedback loop that has pressed stocks to higher to the new all-time highs. So SoftBank has bought huge call positions, and to hedge, these banks that fulfill the call options have to buy the stocks, the underlying assets, and that has driven up prices. So, Kevin, what do you make of this story? Let's start with Ben, actually. Ben, what do you make about this story? Let's bring you in here. What do you make about the story about SoftBank being revealed as a whale? Does it change your outlook about SoftBank?
Well, Andrew and Kevin, thanks for having me, and great to be with you again. So, first, let me say this. Masayoshi Son is a brilliant guy, and he's demonstrated that over more than 20 years. starting with the Alibaba investment and much more since then. Having said that, there's a little bit of a head scratcher because if you're an investor in SoftBank, you're expecting Masayoshi Son to do a couple things. One is to invest in great innovation, and then two is to scale up those businesses. You are not expecting to be taking financial options risk, and the derivative trades that SoftBank put on caused shareholders to scratch their heads. It's the reason why SoftBank dropped 8% in market value in the last 2 days. And it's the reason why a lot of people are scratching their heads and wondering, hey, am I investing in a company that's doing what I expected, or are they trying to extract financial engineering?
And I agree with Ben totally on that. It's a head scratcher, and it reminds me of a couple things. I wonder if number one, that they're doing these options purchases because the bliss scaling model, the WeWork, we all know the WeWork story, has made it harder for them to execute blitz scaling, and this kind of pivot does, I'm from Oklahoma, so Chesapeake Energy was an oil and gas shale driller that got heavily into hedging, and basically became an energy hedge fund and booked a lot of profits and losses every quarter on that. And, the market turned on them and it kind of blew up. So if you thought you were investing in shale drilling, you were a little bit, but a lot of your investment was going to trading energy futures. So it reminds me a little bit of that as well.
Yeah, I think my input here would be that just a couple months ago, Masa Son came out and said that he was going to go into defensive mode, that he it was going to lick his wounds that had come from the first half of the year where some of his high-flying tech stocks had come down in value. But that's been the opposite of what he's done. He's gone out and done something even riskier in these options bets. So that's what kind of, if I were a SoftBank holder, I'm not. I would feel, I think I'd be a little bit upset that he deceived me in that way. But something that interested me is that the source for the Financial Times says the whale is still hungry. He says that this is not the end of what Masa Son is going to do. He's going to keep going. I want to ask Ben, if you were a SoftBank holder, what would you think about this plan? Even after people have come out against him, the source says that they're going to keep going with this plan. What would you feel?
Well, I think two things. First of all, I'd say, you know what, if I wanted to invest in a hedge fund, I'd go invest in a hedge fund. It's not the reason why I picked SoftBank. And then on the other hand, I guess I'd also give Masayoshi Son some credit, which is he made money on the trade, and that's a good thing, right? And so, what was the line about Brutus? And I'm going to mangle the Mark Antony quote, but the bottom line is that I wouldn't shovel dirt on his grave. I mean, he did, after all, just make money on this, but I personally would say, look, if I thought I was investing in SoftBank as an engine of innovation, and I realize that I'm now making money because they're operating like a hedge fund, I'd probably evaluate whether SoftBank is the best hedge fund in which I want to invest, and do I want to do that, or do I want to pick something else? My personal view is it's very hard for a company as big as SoftBank to continue to be an innovator. There's a long history of companies that were great. I mean, you're talking about the energy industry before. Look, the most valuable company in America, I believe a decade ago, was Exxon, and now it's nowhere near the top. It's hard for big companies to continue to innovate, continue to stay on top, and I think it illustrates that if I'm looking to invest in innovation, I'm probably more likely to be looking at the small, high-growth challengers to a SoftBank than I am to a SoftBank, and that maybe is a good foundation for what I know you guys are looking forward to talking about over the course of the session, which is where there's real innovation and where there's real growth. I don't think it's at SoftBank. I think it's elsewhere.
Yeah, you're leading me perfect here into where we want to talk about real innovation, whether this company is an actual innovator or not. This is the biggest news of the day, the biggest news probably of the week that we're going to get, and this is the NKLA-GM deal. I know you want to talk about this. Anybody that's been following FreightWaves today have noticed that we've been talking about it a lot because it's big news. The news broke this morning of a partnership between General Motors and NKLA. NKLA had been searching for a manufacturing partner to produce its line of pickups, the Badger, for some time now. GM will take an 11% equity stake in NKLA, and they'll have the right to nominate nominate a board member in the future. But GM is going to engineer, test, and manufacture the Nikola Badger. They will also produce the fuel cells for the trucks and future fuel cell Badgers, and they'll also produce the batteries. Their Ultium battery is going to go into the Badgers and the Class 7 and 8 pickup trucks. The market loved this deal. Nikola's up something like 30-40% today. GM's up 8%. Ben, how big of a deal is this for Nikola? Does it validate them as a real player?
It's a huge deal, and I think it's a huge deal for several reasons. One, as you noted, having GM come in and get involved is one thing, but it's not just money. The $2 billion stake that GM is taking is a big deal, right? I mean, compare that to the $500 million stake that Ford took in another electric vehicle company. You know, $2 billion is a big number, but equally important to me is what it signals in terms of their business model going forward. So GM is going to become a key supplier for for Nikola, and they'll be supplying electric batteries, fuel cells, et cetera. That means something important for Nikola and something important for GM. For Nikola, it means that they're going to have the benefit of a high volume, high quality manufacturer that will help them ramp up. For GM, it means maybe GM gets a future where they're not just an OEM, but also an automotive supplier, which, by the way, tends to be valued more highly than OEMs. A third element of this that is interesting to me is this represents an open system challenge to Tesla. So if you think about it, Tesla is a closed system. It's kind of like Apple, right? Everything is made in-house. Tesla controls everything, the software, the hardware, the manufacturing, kind of they're all in. Nikola is going open source. They're saying, you know what, we're going to build parts of the model. We're going to use GM for others. We'll have other players as well. So kind of like Apple versus Google, where you have a walled garden versus an open ecosystem, you have the same makings of a battle here in the automotive world. And I don't think it's a coincidence that while GM stock went up and Nikola stock went up, Tesla stock went down close to 20%. Now, you could argue there are multiple factors. Tesla not being included in the S&P 500, may be a factor. But in my view, the market looked at this and said, gee, there is now a credible threat to Tesla on the electric side that maybe we didn't take seriously prior to today's announcement. Having GM come in validates the model, validates Nikola, validates the open architecture model. And in my view, while this is all still early and speculative, it represents possibly the most formidable challenge to the Tesla business model to date. And one last thing that I want to add, for GM, this is also their first move into electric trucking. And so it also gives GM access to a bigger market, doesn't have the same conflicts that someone that's already in the space would reflect. So I think it's a very big deal.
It's a great point Ben brought up on closed source system or closed source ecosystem that Tesla runs and open source. I hadn't even thought about that before, so excellent point on that. I think I think Alan Adler, who covers Nikola and all the auto manufacturers, both legacy and the alternative fuels, here at FreightWaves, pointed out earlier today on the midday market update is that there are some analysts calling for GM to kind of consolidate their alternative electric, I guess hydrogen now, type of investments and spin that off because of the valuation concerns that Ben brought up a bit. And this gives them an opportunity to increase that portfolio for an eventual spin-off of those assets to juice the valuation.
I think that's totally right. In fact, in some respects, it reminds me of the tracking stock moves that companies like Liberty Global have made in the past, or EMC with their high growth kind of software, networking equipment business, VMware. It may be a way for the market to get to realize more value, but there's a financial engineering element to this, and then there's a business strategy element. Financial engineering, I think, no doubt, you look at the premium that the electric vehicle companies trade for relative to GM, it makes a lot of sense. But I think equally important is what is the signal for GM strategy going forward? Are we going to see GM make more investments like this on the electric side, on the hydrogen side, on the alternative side? And will GM be positioned to be one of the big winners in this open architecture? I think it positions them very well on both fronts.
Hey, Ben. Andrew here. So, although Nikola's never produced a single car, nor a battery or any product for that matter, they are currently valued about a quarter of what GM is valued at. They've been around for 120 years, sold nearly 8 million cars last year. Who got the better end of this deal? It seems that Nikola might be getting away with the steal, but GM didn't put any money up front in this to begin with. So who got the better end here?
Well, if you just look at the stock market, Nikola went up 50%,
Wow.
GM went up 10%. So you would say Nikola because it gives them the huge validation relative to what
Yep.
they had before. On the other hand, if you look at aggregate dollars, actually the total amount of market value that each gained isn't that different because if GM is worth 4 times what Nikola's worth and they're up 50% versus 10%, you could argue that the market is awarding similar value increases to both of them. Meanwhile, if Tesla is down 20%, you could argue that Tesla is down that much more. I haven't done the math to be precise about this, but I'll bet you the Tesla 20% decline is significantly more than the 50% increase in Nikola plus the 10% increase in GM. So, but the other thing I would say is, look, the market is the saying in the short run it's a voting mechanism, in the long run it's a weighting mechanism. So the real question is how does this look a year from now, 2 years from now? And my guess is, look, they both won, and they'll both continue to win because it makes strategic sense for both GM and Nikola.
Yeah, I completely agree. And Andrew's my answer to that question is that someone called Nikola not too long ago just a business plan. But they're executing the business plan like you should. You're partnering with larger players that bring a lot of not only cash but a lot of talent and a lot of means, a lot of production, a lot of expertise to where you haven't made a car yet, you haven't made a truck, you haven't made a big rig yet, but you're lining all the pieces up right now to be able to do that without a lot of the investments on your end to build that infrastructure.
Yeah, they've saved themselves billions by not having to build out these truck lines. And what's his name? Trevor Milton said today on his interview with Andrew Sorkin and Mary Barra on CNBC, he said that they never planned to have truck lines. They never planned to build out trucks. So this is a big deal for them. And it's a big win, I think, a massive win and validation for Nikola. So let's move on to our last topic here. And this is something I have 2 topics, but we're only going to have time for one. And we're just going to pick the one that I think is very interesting and quite funny. So, Ben, you posted about this on LinkedIn, and this is Sarcos Robotics. They're based out of Salt Lake City. They just raised $40 million to help accelerate the development of these exoskeletons. These are robots that augment humans. It makes them much stronger, something like 20 times stronger. And I've actually got a short video here that I'm going to have the team play for you because they're kind of hard to imagine unless you see them. It was a stretch from my imagination. So here, play the video for us, guys. Thanks.
And so he's just going to grab onto this thing, get some of that form and force closure we talked about, and he's going to line up those rails and slide it in. That is one person doing a 3-person task, and that's what the exoskeleton can unlock in many different industries that we're really excited about.
All right. So yeah, it was a stretch from my imagination to see those things. They remind me of something out of a Call of Duty video game. That thing's about 20 years in the making, Ben. Sarcos has been around since the 1980s, but in recent years has raised nearly $100 million to help commercialize these things. Do you really think there's going to be a demand for these things in warehousing and logistics?
Well, here's the thing. I remember when RFID came out, and everybody said this is crazy. It costs $50 per tag. Who's going to put a $50 tag on a $10 bottle of whatever CPG you want, a $3 tube of toothpaste? But the answer was when you manufactured at scale, that $50 tag came down in time. When $50 became 5 cents, it was cheap enough for mass adoption. So I think about it the same way. I mean, are you going to pay I don't know, 100 grand a suit or whatever the cost is for someone that's $40,000 a year worker in a warehouse to increase productivity? Probably not. But with scale, as the cost per suit comes down, can it make a big deal? Yeah, I think it can. And what I love about this is it's a great illustration of the fact that there's this false dichotomy. You alluded in my LinkedIn post between man and machine. It's not man versus machine. It's not like in one corner There's the warehouse that has no technology and it's just a bunch of guys operating the way they operated 50 years ago. And in this corner, you've got the 100% fully automated warehouse of the future. No, it's really man plus machine. So the idea of somebody with an exoskeleton that can lift dramatically more, it could be 2 times, 3 times, 4 times more productive. Hey, that makes sense. And, I think you will see that happen. You'll see that be adopted in high volume warehouses, especially think about this. If you're locating a warehouse somewhere that's expensive, it's an in market, like you're serving New York and you've got a high velocity warehouse in New York where the real estate's unbelievably expensive. If having an exoskeleton means that you can operate with much more velocity and therefore not need as much real estate, you know what? Maybe you don't care as much how expensive the suit is if it means that you're saving on the much bigger ticket item, which is the real estate. So, I think it's on the one hand, the jokes are fast and furious about, Jetson's technology in a warehouse. But I actually think there's something to it. And I also think there's a reason why you have corporate backers here, Caterpillar, GE Ventures, Schlumberger. These guys know that if they can extract more productivity in their own industrial settings, or if they have industrial technology that could be more valuable in combination with this, that makes a big difference. So are we going to see this reach mass adoption in 2020? No. But could we see it over the next 3 to 5 years? Yeah, I think we could.
I'm just excited to see, or at least I'll say I'm looking at this video thinking, all right, it moves like a snail. And I wonder how it's going to compete with, those Boston Dynamic robots that move like canines, that move like, they're like gymnasts nowadays, and they're only going to get better. So I'm excited to see how these machines innovate and iterate and get to a better position where they actually move well, but they move kind of like snails right now. So I'm excited to see how they grow. We may just be looking at the first version of Iron Man suit. We don't know that yet, but I do think it will get better than just being able to pick up heavy things. So it's going to be fun to watch.
I think it'll be fun to watch. I'm more. I like to call it more of a RoboCop. I think more of RoboCop than Iron Man, which I don't know why. Maybe because I'm a child of the '80s. But I think another thing, Ben nailed it with productivity. I think safety. I think there's a lot of oil field services. There's a lot of heavy machinery. Sometimes we think about warehouses as parcel CPG items. But there's heavy industry all around the world with really heavy products and really large, significant safety concerns. And I think an exoskeleton could solve a lot of safety issues. Certainly, back issues and dropping things and workman's comp. So I think that's another area where I think this will work out very well once we can manufacture these at scale.
Yeah. All right. Well, I think we're about to have to wrap it up here, Ben. We, again, didn't get to Amazon acquisition rumor mill nor the antitrust conversation. We're going to get to that one day. We'll have you on again here in the next couple of weeks because you're always interesting and great to talk to you. Thank you so much today.
Andrew, Kevin, thank you both. Great to be with you.
Thank you, Ben. So, Andrew, I think we have 2 minutes left in the show. So,
what do you guys got going on at... What do you guys have coming up on Put That Coffee Down tomorrow? I saw Dooner's already out getting it on social media.
He is. He's already out promoting it. I'm going to promote it later on today. It's about freight brokers and reputation. A lot of ways we are, or I say we are, I'm a former freight broker, so we're traders of transportation, and we get blamed for by either party if prices or rates go up or rates go down. So we're just a messenger, really. We're tacking on some margin for our sales effort and kind of, managing the deal. But if rates go lower like they did in April, bottomed out, we don't really control the market dynamics. It's all about supply and demand. When load volumes crater, rates are going to crater. When we get into environments like we're at right now, where it's a very hot market, there's a capacity crunch and rates go up, shippers don't like us at all because rates are going up, but we're just a messenger. We're like a stockbroker. The market goes up, down. The stockbrokers don't really have any control over that.
All right, that sounds great. For everybody looking out for the Passport team, looking out, we've got 2 papers coming out this month. I think that are going to be really great. They're both partnered. One of them is Vector IQ, something with Vector. We're doing a carrier fleet technology systems market share paper that I think is going to be great. And then the second one, we're doing a Redwood automotive trends in automotive shipping. So be on the lookout for either of those, both Passport customers and everyone alike.
We also have the carrier rate report that just came out last week as well. And it gives you the outlook of carriers for the next quarter, and that will wrap it up for today.